We see 2019 being another challenging year for investors. Whilst we don't expect recession, there is clearly going to be a slowdown in global growth. Chinese-US trade wars have affected the system, and stock markets don't necessarily wait for recessions to happen, they often come ahead, so we do see continued volatility in 2019. That said, we prefer equities over bonds. Why is this, given we expect volatility? Basically, you're not getting paid enough, in our opinion, for holding bonds. The US government bond is approaching a decent value, but is not yet there, in our opinion. When you buy a corporate bond fund, what you're doing is buying company debt, and you need to be paid a bit of extra to take that risk over buying a government bond, and we don't think you are at the moment. Equities broadly are yielding quite a decent sum, with the FTSE 100 yielding around 4% today, and you are at least getting compensated for taking that extra risk. While equities may be volatile, we will hopefully see some better buying opportunities in 2019 for adding to portfolios and exposure generally. When it comes to developed markets over emerging markets, we find this quite a tricky question. Certainly on a valuation perspective, emerging markets look better value. But with the US raising interest rates, there's a decent expectation that dollar will remain strong in the first half of 2019. And historically, a strong dollar is bad for emerging markets. So whilst there is clearly better value there may well be better value to come later in 2019. US growth is still moderately robust, although valuations are not particularly keen, so we tend to prefer Europe and Japan on relative valuation basis. If you believe in mean reversion, as many do, you would clearly be looking at value funds at the moment. Growth funds have had the majority of style favour for most of the last 10 years and have done extremely well. The opposite of that is that value funds have actually underperformed growth funds for the majority of the last 10 years, apart from a couple of small times in 2016, particularly when value funds did very well. What we believe today is that rather than having a very strong tilt to growth funds, that value is now so cheap that actually it remains a compelling investment opportunity, and you would certainly want to have a more balanced portfolio rather than just the growth funds which have done so well for so long. Over any decent long-term period, small companies outperform, but with that does come extra risk. You have an liquidity risk, and when market falls they tend to be more volatile because of that. So if you are cautious on markets, maybe now isn't the time for small cap. With all the Brexit uncertainty in the UK stock market, for instance, we have this inverse relationship where if sterling continues to weaken, it actually boosts companies in the FTSE 100, which is the large cap index. If you believe in a continued weak sterling, or even weaker, then maybe large caps are the place to be. Plus, they do tend to pay slightly higher dividends and be slightly less volatile than their smaller company counterparts. Given our thoughts in some of those themes, some funds people might like to consider. Firstly, I've gone for a global value fund, which is Investec Global Special Situations. This is a contrarian values team that they have at Investec, and the global version has been running successfully now for about 3 years. It's got good performance, even though value hasn't done so well. But if value were to return to a predominating feature, then we would really expect this fund to outperform. Another value fund, in fact trust, is the Fidelity Special Values Investment Trust. This is run by Alex Wright, who also runs Fidelity Special Situations Fund. He is an out-and-out value contrarian investor, and one that if that value style does dominate in 2019, we really would expect extremely strong returns from that Fidelity Special Values Investment Trust. Given one of our preferences in equity land in 2019 is Europe, a fund that invests in European equities run by John Bennett is the Janus Henderson European Selected Ops. This fund has a bias to mega and large caps, which may well be the place to be in 2019, and doesn't have historically a particularly strong value or growth style, so could be one for core European investors in 2019. One fund you might like to consider for 2019 is the AXA Framington Japan Fund. This fund invests in Japanese equities and is a good core fund spread across the market cap. Japanese valuations do look relatively attractive, and hence we think this could be a good fund for 2019. For more information on our outlook for 2019 and information on funds mentioned, and in fact all elite rated funds and investment trusts, please visit FundCalibre.com.